This is Josh Jelinski, the financial quarterback. Don't touch that dial. Big news came out the other day that BlackRock is getting into the private equity business even more. Did you hear about this, Barry?
Oh yeah, they're in it with both feet, Josh. But also, did you hear how much they lost in January on one of their investments?
No.
Oh yeah. They lost $600 million on a company called Altrity, Altrity. It's an insurance claims management company that they purchased about a year and a half ago, and they claimed a internal rate of return of about 33%, Josh. And they defaulted, and they had to turn over the business to their lenders, Blue Owl and Goldman Sachs, in January. Yeah.
With Barry Dyke, best-selling author, advisor, and speaker, committed to telling the truth about how Wall Street really works. Barry Dyke is the best-selling author, advisor, and speaker, committed to telling the truth about how Wall Street really works. Barry's a good friend and been on the show before. So what's up with BlackRock getting into private equity? I don't know if you've heard about this.
The reason why they're going into the business is because their margin compression, and as we know in the advisory space, in ETFs and funds and so forth, the margin compression. So the thing is, let's face it, private equity is 15 times more profitable than the typical asset manager. And the reason why it's called private, because everything's done in secrecy. And as you know, it involves an awful lot of debt and tax subsidies, such as deductions of all the interest. So it's a way really for them to make a lot of money. Matter of fact, it was announced, I think it was in filings this past week or so, the 2 weeks ago, where Larry Fink is getting his part of his income as carried interest, which means that he's getting his income for managing other people's at long-term capital gains rates. So everyone's in the pool. It's this, even Vanguard's into private equity now. It's kind of sad because we're getting so far away from the fundamentals, Josh.
So this was the thing. BlackRock's Larry Fink handed pay perks for his role in growing the private markets. And then this was pretty crazy today. This came out. Fund giant BlackRock is out to unite the public and private markets. Larry Fink built the world's biggest asset manager by making access to stocks and bonds easy. But can the same be done with more opaque assets?
Josh, I don't think it's ever going to end well, because when you look at the conglomerate, we're both in finance for a long time, but if you look at the traditional conglomerates, i.e. the GEs, the ITTs of the world, all these conglomerates, and this is, I'm kind of getting into some of the research, is that they all eventually, and I guess the most recent one would be let's say GE, but you have private equity, which essentially it's a coterie of all these loose companies, and they're trying to be managed, and no one. It's very, very difficult to manage companies, and so I don't. I think long term, right now it's very, very hot. It probably will be hot. Well, it's hot not just in the U.S. but also in Europe as well, particularly in the infrastructure business, which is they want to not only take over companies now, they want to take over your toll roads, they want to take over the water, they want to take over your parking spaces, and they're doing this. But the fact of the matter is, if one researches a little bit, like outside of this country, i.e., something like Thames Water, which is the largest water utility in London, which is essentially in default mode. But under this private equity model, they've been pulling out billions in dividends for the past decade or so, and now it's going to go into default, and the British taxpayer is going to have to bail it out.
So we got to start from like ground zero, because this somewhat confuses people. BlackRock is noted for IVV, symbol IVV, S&P 500 ETF. So their claim to fame was they made funds even cheaper than Vanguard and Fidelity. They put 0.03. So they were heralded for democratizing finance with the ETF. So sort of the Boglehead Bogle. Now they're not making any money and they got to keep the stock higher and higher and higher. So I don't think people realize, like, when you say public to private, I kind of say, well, why don't I get access to the private markets? It sounds like a good thing. If you're buying an ETF that might have a 0.05 fee,
Yeah.
so you put $100 in, you're paying, a fraction of a dollar.
Yeah.
When you put money into the public markets, it's transparent. The fees are generally transparent. When the private, it's not as transparent. But generally, what are these firms making? 10 or 20% on a dollar put in?
Well, Ludovic Falafu, who's a friend of mine, he's the University of Oxford, and this will be coming out in the book, which I'm working on. He says that there's roughly about a 6% all-in fee based on private equity right now. So we know we're doing it for fractions of a penny with an ETF or an index fund, if you will. And there's a real huge problem with indexing, but the thing is with private equity, we're going something which is somewhat well lit and transparent, i.e., the public markets, and we're going to private where it's totally non-transparent. So the thing what people really have to understand about private equity, everything's being done in secrecy. And before you and I were talking before we got on here, we were talking about how private equity is getting big in the life insurance space. The thing is that it's very, very difficult to find this stuff unless you're really a forensic type of person who wants to dig behind the facts, because this stuff is not available to people. Anytime people do things in secrecy, they generally do not end up well. Now, this could be in a business, it could be in a relationship, but people do things in secrecy. And if they continue to deceive people, it doesn't end well. So I think eventually that's going to happen with private equity. This is my thoughts, Josh. Okay, but I know enough, and the thing is that no one's really talking about it and putting this stuff together.
Yeah, there was the guy we have on last week. He was really interesting. And I actually made the connection. Johns Hopkins University professor.
Oh, what's the guy's name? He's a really sharp guy there.
Really sharp guy. He says 20, 40 years ago, you would go to a commercial bank and get a loan.
Yep.
The nature of capitalism changed. Barry, if you bring in $5 million of revenue, I can get you $50 million for your firm. And now what these private equity firms do, they give you money to get you out. They get your income, then they get a higher value, they get a higher EBITDA, then they flip the business and they keep flipping businesses. They pull equity out. It's like vulture capitalism. It's not real capitalism. And he says the only way we get away from that is going back to commercial banking as the heart of the American economy. Like, banks are not lending.
But this is the problem, Josh. Okay. Banks don't do business with even you or I, or any the regular people anymore. The small business is very, very rare. It's very difficult. But the thing what has happened, and this is actually just released by the Federal Reserve. Well,
they do business. They lend money. They just don't really, they don't get us, they don't get going in the morning over doing business with us. They'll do it. They'll have you, sign off a third child to the bank for a commercial loan on your business or something. But it's not really their bread and butter.
Bread and butter now for major banks, your JP Morgan, your Barclays, your Deutsche Banks, Goldman, the whole thing, it's private equity. There's no question about that. And
but I don't blame them. You're talking to me, all these profits. I want to get into private equity now.
Josh, I know your background. You're trained as a minister. I think we're supposed to be of service to people. Okay, and I think and what we do in our work, and I believe that with all my heart.
So what you're fundamentally getting at, and this is where we align spiritually, philosophically, the whole nature of capitalism is sort of sick and twisted right now. Now we are capitalists, mind you. I'm not a Marxist. We are like from the Hayek school of economics. We're Austrian economists. We're very much into that. But the profit motives of business are misaligned with the greater good, and it's all about the person at the top getting a payday, and it's not about providing value to shareholders. It's really about providing value to one or to the private equity firm, and then they strip the company, like the water company of London. If you came to me and said, Josh, I have investment for you. You can invest in a water company, a utility. I would say, oh, that's a great idea.
That's
They're
a
never
great
going to
idea.
lose money because they're just going to keep printing, almost like buying a utility stock. It just keeps printing a dividend. How could a water utility go under? I know how, but I want you to explain for the listener what these people do. And this is where I think you, in your core, this is why it's immoral. Explain the immorality of what they do.
Well, Thames Water, and anyone who, and the thing is,
When you say Thames, do you mean the River Thames, but it looks like Thames?
Thames, excuse me, Thames Water, Thames.
Yeah. It looks like Thames to us across the
Thames.
pond,
You are correct.
but it's
All right.
pronounced Thames.
That is correct. Thank you. I do duly noted. But anyway, so all your major private equity firms, not all of them, but Macquarie, who's the big one out of Australia, and this is not just a U.S. phenomenon, but Macquarie's the big one, and they took over the largest water company in England, and what they did, Josh, is that now the reason why private equity loves these businesses is because they're monopolies. I mean, where are you going to go for water? I mean, you're not going to go to anywhere else, so they're going to go to something like Thames Water. So what they did in Thames is that they set up like these sub corporations, Josh, to pay out dividends. They would borrow money, and they would keep borrowing more money and borrowing more money and getting billions and billions of dividends. And in the end, it didn't work. So there was a ride for like a 10, 12-year ride, but now it's in receivership or default, if you will, whatever you want to call it, the same thing. It's too much debt. And the British taxpayers are going to have to pay for it. It's going to have to be renationalized. And there's other, there's actually a good book on this. A guy by the name of, I have the book right here, who describes this, but he doesn't really get into the Thames thing. But a guy by the name of Brett Christopher, he's a teacher and professor at a Swedish university. But in any event, so you're seeing this stuff, and I didn't know how bad this infrastructure was. And here's the book, by the way. It's Our Lives and Their Portfolios. They're taking over, people's lives, and they're doing this with parking and toll roads in Chicago. And this is the hot thing now. You talk about BlackRock. They bought global infrastructure for 12, 13 billion. I mean, these are huge purchases. And the reason why he bought this company because they're very much in the infrastructure space. So essentially, it sounds like, in the end, they want you'll own nothing and be happy.
Well, correct me if I'm wrong. The immoral part is sort of like they buy an asset that is value, like this river company, water company. And it'd be like you buying a house that had a paid off mortgage, $2 million house.
Yep.
And then they take out debt. What do they take? 90% out in debt, 80%, 70%? What's the typical?
80, 20, but the thing is that.
Meaning they'll take 80% out?
Well, generally they'll take a company, say it was 80% equity. Let's say we have $1 billion business, let's say, for the listener, okay? Let's say the business is right, and when private equity firm buys it, the company is 80% equity or 800 million in equity and 20% in debt. When private equity goes in, they flip that whole thing upside down, where now it's, instead of it being 80% equity and 20% debt, it's 80% debt and 20% equity. It took me a long time to figure this out, but the 20% equity, it doesn't come from the private equity firm. It comes from the limited partners, i.e., you're in New Jersey or the state of New York or CalPERS or CalSTRS or whatever, any of these major corporate pension plans. The private equity firm only pays about maybe 1.5% in that. But when they put the deal together, they get their money out as a transaction fee right out of the chute. So right from the get-go, they're essentially money good. Now, this is the weird thing which people don't understand. It's not the private equity firm that pays for all this debt. It's the company they purchase. So it's like buying someone else's house and you're leasing it out to them, and you're forcing them to pay the rent, but you control the property.
Or it might be better stated, you buy a house from the prior owner for $1 million.
Yeah.
They had the house owned free and clear.
Yeah.
You gave them $1 million.
Yeah.
Then you take out an $800,000 loan.
Yeah.
You, as the new owner, take the $800,000 it's spent. But now the old owner is the tenant, and the tenant's job is to pay the new mortgage that you just took on the property. So there's zero risk for the private equity firm and a ton of risk for the new company, because then they just declare bankruptcy. And this is why these great companies like Toys R Us and then what they also do then, after they do that the first time and bankrupt the company, then they buy it again. So you're doing research for your 2 new books. When's the book come out, and what have you learned lately?
The first book is going to be called Guaranteed Income 2, which is about helping people build better retirement plans. Because the sad state of affairs, Josh, you know this because I sent you a copy of the retirement rules. Am I correct?
Yes, thank you. Is that the new one?
Oh, well, that's the latest one. But I've actually on the guaranteed income. What has happened, Josh? And I'm going to just ask this to you: is that we're the largest industrialized country in the world? Okay, there's no question about that. China's number 2, but we're number 1. Okay, in terms of retirement preparedness, in the top 30 countries, where do you think the U.S. stands as a country?
In the top 30, 28.
Pretty damn close, Josh. 29.
That's because I know you.
Yeah, so this is Mercer out of Australia. Each year they do a pension survey who has the best retirement plans, and the thing is, the fact of the matter is, we have a huge retirement crisis in this country. And actually, this is what Larry Fink just talked about in his last year and in his annual letter to shareholders. The problem of the country's debt, and the problem of the retirement plans, and he's 100% correct. The thing is that how you and I get there are how Larry gets there and how I recommend is 2 different ways. I'm more conservative than him, and I don't think that some of their methodology are going to end up well. But only God knows what's going to happen.
In the Retirement Ruse, and this book, I will purchase for you if you schedule and keep your no obligation review at 888-988-JOSH, or you could go to barrymdike.com and buy the book for $39.95. And the Retirement Ruse, it's called Stock Buybacks, Cryptocurrencies, Unicorns, and SPACs Help Destroy American Savings and Retirement Plans. It's a mouthful, but it's true. I mean, how did all of those things destroy Americans' retirement?
Well, the buybacks and which is, it's really kind of non-productive use of capital. And again, we're both capitalists. I'm a small business person. You are. I've owned a number of businesses for a number of years, and as well as you have. But the thing is, with stock, the way corporate executives get compensated today, Josh, is primarily through stock compensation. And the whole idea stock buybacks is really discouraged in a lot of other countries, but not in the U.S. And actually, it was actually illegal until I think it was Reagan who actually let it happen in 1983 or so. But so essentially, anytime your stock buys are a way really to reduce outstanding shares and essentially to increase the share value. Now, the thing is, when you take cash and put it into and buy back shares, you actually generally increase the value of your stock, which primarily benefits the insiders and executives. It's a form of stock manipulation, and it wasn't until 1983 in this country. but the whole thing, these things backfire too, in which people now generally, they work, but not always. Like Credit Suisse, I spent like $3 billion buying back their stock before they went bankrupt. I think J.P. Morgan. I think I spent like $80 billion, and their stock has really gone nowhere. Um, Companies like Bed Bath and Beyond bought their stock back, and they went bankrupt. So, and GE, they spent, I don't know. Jeff Immelt spent like $20 shares, and the shares went down by 30%. So it doesn't always work. And so the whole thing is, some money it's getting very, very perverted. So I suggest people just buy the book and read it, because it's somewhat technical, but essentially it's a form of manipulation. Cryptos, I talk about cryptos simply because, Josh, I don't know what you think about cryptos. The more I know, the more I don't know. I have a very highly respected tech guy I know, thinks that they will be important at some point, but most of the stuff which I've seen is still a scam. There's so much of these scams, and having a little portion, I'm not against it. I have some people who've made $1 million in cryptos, but I'm saying for the general population, this still doesn't make sense. And then I get into things like unicorn investments, we're just coming off from a hangover from the pandemic, Josh. I mean, I think over 100 billion. I know that over 100 billion, 150 billion was put into EV startups in self-driving cars, and these things are crashing left and right. Matter of fact, you know what happened this week? Nikola, the big hydrogen fuel cell, which they had the California Department of Energy invested into it, and Fidelity invested in the whole thing. They went BK this week, Josh. And then you have these other ones like Proterra, which is the electric bus company. They went bankrupt, and I go on and on. So I actually list all these bankruptcies, and then I get into the SPAC thing, which is it's they used to call them blind pools in the 1920s. So everything on Wall Street has really been around before, but you have these phenomena of SPACs. Now, Nikola was not only the high tech blow up, but it was also a SPAC blow up. So you're seeing just the manipulation in share prices that I find incomprehensible, Josh, and it makes Bernie Madoff almost look like a piper.
You know what I want you to do? Have you read the transcript of the XRP, the SEC against the XRP?
No, I haven't.
And how under oath these XRP executives expose themselves? Basically many cryptocurrencies, and I'm a big believer in Bitcoin because it's different. It's a totally different animal than most cryptocurrencies. But what they do is these central actors raise money, almost like an initial public offering. They have an initial coin offering. They pump the coin. They dump it on the unsuspecting public, and then they go away. And the SEC may lose the case against, they lost one, then the SEC appealed, and Trump may usher in a glory age for XRP and those, but XRP is very distinct from Bitcoin. And read the testimony in these court cases. It's pretty shocking what the founders admitted to, and basically like it was a scam.
The biggest scam was of course FTX Alameda. Okay, and the amount of money, 1.8 billion, Josh, was put into venture capital. We had all the celebrity endorsements from Tom Brady to Larry David to who's that? Kevin O'Leary from Shark Tank, and everyone's saying how great it was. And well, they went bankrupt, and all these people like Thoma Bravo and Blackstone, BlackRock. I don't know. Did these guys even look at a balance sheet of these guys? I mean, I'm saying they put 1.8 billion now, and 8 billion now. The whole thing is, Josh, these things are going to take years to unwind.
XRP, by the way, is the third largest market cap cryptocurrency. 147 billion market cap. It's only a third of what Ethereum is. And Dogecoin, which is a meme, this is a joke, is worth 35 billion. But the testimony in the case was pretty telling.
But the question, will anyone go to jail?
Probably not.
This is the whole thing, Josh. I mean, you and I are small business. We're advisors. We're under a microscope. I mean, when you look at the subprime crisis, I think there was only one investment banker that went to jail. It was a Credit Suisse guy, and then they went up under anyhow. But there's over, and then you'll see this in the book. There's over a third of a trillion fines and conduct costs have been paid since the financial crisis, Josh, and only one guy has gone to jail.
Who was it?
It was a Credit Suisse banker.
Oh, wow.
So we're just seeing this wholesale type of criminal activity. And I think as stewards, particularly when you're looking at people's retirement, the reason why I'm doing this is because America is a third world country, in terms of retirement planning. So I'm trying to help people build better systems so they can retire and have peace of mind. And the fact of the matter is, Josh, if you're really rich, or if you have the benefit of being in a union pension plan, you're going to be fine. But for the vast majority of Americans, they're not there. So I think really we got to get back to the fundamentals, and that's just my opinion.
What other things have you been researching that you find alarming? And then we'll go over to what you research that's positive and where we should be putting our money in these uncertain times.
I came to this conclusion too, that people need to use insurance companies for their retirement. There's no question about annuities. And if you study, Josh, and I have done this, I've actually researched all the top retirement systems of the world, and the top systems are Netherlands is always number one.
Why?
So Netherlands, they all have something in common. Okay, so the Netherlands is always number one. Israel is up there. Iceland's up there. Denmark. Switzerland, the Nordic countries, Denmark, Norway, and so forth. You know why they're always near the top, Josh? You know why? Because they're all annuity based, all of them. And I would testify in court to anybody on that because I've done the research.
But I thought annuities are a bad thing. You're a fan of annuities?
Well, the only thing that works. I mean, if people don't like annuities, they don't like pension plans, they don't like Social Security, and because that's all a pension plan is an annuity for life.
Why do you think they get such a bad rap?
Well, because it's competition for the asset managers. The asset managers want to gamble with everybody's money, okay, and have no accountability. And guess what? In America, there is no accountability. Okay, and if you look at even which is amazing research, are you familiar with collective investment trusts?
Yes, but explain for our listeners.
Well, collective investment trusts they're essentially more than 50% of all 401k retirement plan assets now. That's verifiable, and I have the facts to back it up. Now, the thing with the collective investment trust, they don't have to file a prospectus. You can't get the data from they're not available from the newspaper online. Okay, you have to go through a representative, and because they're not under the SEC, they're really regulated by the banks, local banks, and within the state and insurance commissioners. And as we know, that's not very good. So the SEC's done a horrible job for the most part for the American consumer, anyhow. But with the collective investment trusts, you don't have the oversight that you have with the mutual fund, where everything's transparent. So you can't figure out. Now, the thing is that more than 50% of all retirement plans are in collective investment trusts. They're all using them. BlackRock's using them. Fidelity's using them. Vanguard's using them. And the reason why they love doing it because they can stuff alternative investments into them. And they can stuff crappy annuity products into them as well. And so there's no transparency. So no one's really.
Yeah, it's being sold that to people that the collective investment trust is like a lower cost index fund. But in actuality, it's very opaque.
The first company really to use these in kind of a nefarious way was Intel, and they used these collective investment trusts to start stuffing private equity and hedge funds into their 401k plan. Now, the thing is that it went to a court case and the whole thing, and the people who had a class action suit, and they lost the suit because they said it was disclosure. You know how it is with investment choice. As long as you disclose anything, you can get away with it. So the fact of the matter is, companies like Intel were putting in, really kind of crazy investment into people's 401k plan, and it didn't end up well. Now the whole thing is, so this is what we're seeing more and more of.
You talked about crappy annuities. How do we distinguish between a good annuity and a crappy annuity?
I only use mutual coverage fraternals. That's it. I'm sorry, man. I'm hanging my head on it. Anything which is owned by, your part owner of the company, I'm all in favor of. Okay. And anything involved with private equity or stock company, I don't want anything to do with them, because I understand how they're using reinsurance. They're using offshore reinsurance. They're using captive insurers to masquerade risk. And so, and luckily, I've been very blessed to know Tom Gober. So I knew really from a moral perspective these guys were crooked, but he really showed me what they're doing with their how they're really obfuscation. How do you say that? I forget how you say it. But
obfuscation.
Yeah, obfuscation of risk. So they're putting the domiciling their reinsurance in Bermuda. So we don't know what they have for reserves, or they're doing.
I'll push back a little bit because I'm friends with Gober too. I love him. But he's been talking about this for years and nothing's happened. Number one, nothing bad's happened. Number two, the companies that he critiques just keep getting bigger and bigger and bigger, and they're over. Like Athene, for example, they're owned by who? Apollo or one of those
Apollo, yeah.
But they keep growing and growing, and New York,
which is frightening.
New York has one of the strongest regulations. I mean,
yeah. Well, the whole thing is because we don't know.
I get it, but you think they're trying to lose money?
They're running in front of it. They're front running the whole thing. And the thing is that no one's figured this out yet. Now, Tom and I have figured this out.
Some of the companies I get. Barry likes annuities and life insurance policies, cash value, that are by mutual or fraternals only. He does not like stock or private equity owned companies. And I get it. We've talked about this for a while. And Gober says they offshore everything into Bermuda, where they do these extra domiciles so that they don't have a level of scrutiny on what they manage.
They don't.
They say they do that so they have lower cost of regulatory burden so that they can make more money that can be shared with the policy owner. I'm not taking a side on that. I agree with you in part. It looks fishy, but Gober just says, I don't like it because they're non-transparent. We've had him on. I don't know if he's entirely convincing. Do I like that they're non-transparent? No. But I wonder what his angle is, where if you just diversify different insurance companies.
Well, this is the whole thing. This is where Tom and I, he knows what we talk, quite a bit, obviously, but what I brought that Tom didn't know about, there have been failures. Okay. There have been failures, folks. Okay. You don't believe me? Google a little company called Eurovita in Italy. Okay. Owned by private equity firm Civin into receivership. Okay. A major disaster. Okay. You don't believe me? Google folks out there, Google Global Bankers Insurance Group.
Yeah.
Okay.
No, I know it can happen.
Okay, 777 Re. Okay.
Yeah.
I mean, they've essentially been shut down, Josh. Okay.
But you're not talking about 777 Re. You're talking about some of the biggest companies in the world.
Yeah.
I mean, how much does Athene manage?
Well, a lot.
I mean, I would not put Athene in the same category as 777 Re. That's all I'm saying.
No, I know, but the whole thing is it's the same process. Okay.
Do I love them? No, I'm just saying, do I place money with them? No, but I'm just saying, you got a company with 360 billion in assets. I've just checked this out by their website. It's probably more now. They just keep gobbling. It's just like you've never liked security benefit and the Dodgers, and they just keep winning, man. Now then they buy the
Yeah.
Dodgers, and you
That's
used to critique. I'm having just fun with you. But you
okay.
used to critique Guggenheim for owning the Dodgers. And you know what? They've turned the Dodgers into a trophy asset.
Yeah, but did you hear about NPC International?
No, I want you to tell me about me. But what I'm trying to say is the argument goes, if you're losing us, the problem that Barry has is if you place money with an insurance company or an annuity company, I agree, there should be a level of transparency as to where the funds are and audited. A lot of these companies are escaping the US. They're going to Bermuda. They are creating separate entities to escape the oversight of the states that govern insurance companies. I agree. I don't like that. I'm not saying I like that. I'm just saying their argument is we do this to lower regulatory costs so that we can invest more. One of those companies is they own the Dodgers, the LA Dodgers, and they got a lot of flack for, they're buying the Dodgers. They're buying a trophy asset. And they bought the Dodgers. What did they buy the Dodgers for? They bought the Dodgers for like
$2.1 billion.
And now the Dodgers are probably worth $10 billion. So they made money on the Dodgers.
Oh, and believe me, I had an argument about Tony Robbins approached me like 10 years ago, co-authoring a book. And I had an argument with him. Remember this, okay?
Can you tell that story? That's a crazy. You want to tell that story?
That's a true story. Yeah, Tony Robbins, and he'll be in one of these books, by the way, because he's in love with private equity. He approached me about co-authoring a book, and because the other books I had done, and because he was doing one on annuities, and because the fact of the matter is, people need to have annuities for retirement lifetime income. That's really one of the best instruments anyone can have for retirement. There's no question about that. I'll talk with any actuary or any economist. All the economists agree. Matter of fact, I'm in that movie, The Baby Boomer Dilemma. All the economists in the world agree with me. Okay, so I'm saying, and we have America's got a retirement system compared to the rest of the world. So you need to have annuities. So the thing is so we need to have good products, okay? So one of the only things which hasn't been corrected by Wall Street has been the annuity space, but now it's being corrupted. And so they're using it not just they're using it as a piggy bank. And actually, they all copied Warren Buffett, who started doing this with National Indemnity in 1967. So they're all playing copycat to Warren Buffett, and because with the Geico and so forth. So, but not like Buffett. Buffett owns companies forever. These guys want to flip the companies, again and again and again. And so also, but what they're doing now is that they're creating private credits. So with insurance portfolios, so people, it's very difficult to figure out. But this is what they're doing.
I get it. I'm just saying, Gober, I remember you bringing up, they're taking your hard-earned retirement savings and they're buying the Dodgers. And the problem I do have with it, though, this is the problem I have, a fundamentally moral problem. You buy an annuity, let's say, for a 5% rate of return. These companies are making, they bought the Dodgers for $2 billion. It's probably worth $7 to $8 billion right now.
Yeah.
They get that $6 billion of profit. They don't distribute that as like a dividend to the annuity holders. That's my fundamental, because I think some of these companies probably are doing a good job managing the money. But my fundamental issue is that wasn't owned by the policy holders that lent them the money. I think the whole thing's a moral issue that way, because the ownership of the Dodgers, they're distributing. It's very interesting, too, what they did with Shohei Ohtani. I think the Dodgers could be a problem, 10 years from now, right? They're stripping all the equity out. They're doing all these deferred deals, and then 10 years later, they'll sell it for $20 billion and they'll be gone.
Well, there's major problems. If you look a little bit deeper, see, because they're not just involved in the Dodgers. As you know, they bought was it Chelsea FC, the football. They bought all these British soccer clubs, which are big things.
But they run them better. The argument is,
yeah. But you look at Clear Lake, who actually uses private. They actually investor money to buy that company. I mean, Clear Lake, they just put Wheel Pros, which is a major company, into bankruptcy.
Yeah. No, I know there's bad stories, but there's also some good ones. I mean, Dodgers made a lot of money. My problem is they don't distribute the gains.
No, they don't. It's all about them, Josh.
They're kind of on the backs of America's retirement savings, becoming billionaires. And you're at a 4% return, and you lent them the money. That's my kind of issue with it. But I know, I'm not saying you're wrong. I'm not saying it's bad. I'm just kind of giving a counterpoint. So what other things do our listeners need to know about problems you're investigating before we wrap it up? Anything else?
Well, the major problem is that, we're a third world country when it comes to retirement system. That's really a major problem, which I'm really kind of focusing on because it's the largest country in the world. We have horrible third world system. Actually, Mexico is rated better retirement system than the U.S. Can you believe it?
No, but define this third world, meaning what you're fundamentally saying is that the average retiree has a predominant, let me phrase this the right way, has a predominant amount of their savings at risk. So when you're saying we're ranked 29th, the reason why there are 28 countries that are better is because when they invest for retirement, they have a pension or an annuity or something of a guaranteed. So when we're getting $1 of a check as an American retiree, we could lose 50 cents on that dollar due to the market. Our retirement savings is predominantly market-based, whereas in these other countries, they have a safety net that we don't have. That's what you're saying when you say third world, right?
The purpose of retirement plan is to produce retirement income. End of story. I don't care what you say. The purpose of retirement plan is to produce retirement income. That's what it's named, retirement income. And we know that this is what the rest of the world says. Retirement plan is supposed to produce retirement income. But the U.S. is like, no, we're going to gamble with it. And we don't want any accountability. And we're going to tie you up with arbitration and everything else under the sun. And so you have nothing to say about it. And so what I'm saying, and the game's rigged. So what I'm saying, here's a better way to do it, and using annuities. And I'm saying if you use annuities, just be really careful and use fraternal and mutual companies.
You've been a crusader on this for years. And you've been instrumental in my own career because we met in 2006. So we met, or 2005. And Barry Dyke was like Chicken Little. He was saying, the sky is falling, the sky is falling, kind of like he is now, to be honest. And there's a major problem with our systemic economy. By the way, what nobody tells you is I believe you're 100% right. And that's why Biden gave the Treasury, Janet Yellen, a blank check a year or two ago because they saw what was going on with Silicon Valley Bank and they knew it would cause another '08 crisis.
Which is not capitalism. That's not capitalism. I mean, bailing out Sequoia. Yeah, well, yeah, so the failure of Silicon Valley, they should have gone down, okay? The Silicon Valley and First Republic, two banks, and I have the facts that back me up, Josh.
And you called this years ago. You were calling First Republic when they were a venerable New York institution. I remember you were calling them out 10 years ago.
Well, because it had private equity background. I mean, it was owned by General Atlantic and Colony Capital, okay?
But what about the people who said, well, they gave them a blank check. Everything's good now. We overcame that crisis.
They bailed out the banks. They bailed out Sequoia Capital.
Again, what they said they never would do. Talk about that. People don't even get that happened. So what happened?
The fact of the matter is, and I know, believe it or not, because when one of my son works, I know this firsthand. I know about Silicon Valley Bank. I know firsthand. Okay, and I can't get into it. Okay, but I know from a first hand. Okay, that institution my son who was working with. Okay, had a lot of money with Silicon Valley Bank. The fact of the matter is, we know that the government's supposed to give you with 250,000 per account, and then that's another story into itself. But and the fact of the matter is that there was like 90% of I think the money was over the 250,000 limit, and the fact of the matter is the FDIC, which has no insurance money, by the way, it has very little. So they have to coddle the Treasury. Um, we had to put 20 billion between Silicon Valley Bank, Josh, and I have this in the book. Silicon Valley Bank, First Republic Bank, Silvergate, and Signature Bank in New York. We had to put 50 billion into those to keep, and essentially that was bailing out.
All unaudited, by the way. I hope Doge audits this.
Yeah, so the whole thing is Sequoia Capital, who all these, which is a big private equity / venture capital firm, and there's very little. There's going to become less and less difference between venture capital and private equity, by the way. So Sequoia Capital has $1 billion, and they get made whole. Matter of fact, we even we bail out Circle Internet, which was it's a startup, which was backed by Goldman Sachs and Fidelity and stuff like that. They had $3 billion on deposit with Silicon Valley. They were made whole. This is not capitalism. This is oligarchy, whatever you want to call it.
You like annuities. You like insurance. You don't like private equity. What's going on in the private equity world?
No.
You don't like private equity on insurance policies or annuities?
No.
Do people read your books and then they don't trust anything? So then they don't even trust placing their money with. So if I'm meeting you and I got $2 million to invest and I'm about ready to retire, how much should I have in the market versus guaranteed income products?
You should probably have roughly half, I would say, generally. I'm just as a rule of thumb. The producer, so first of all, I'm not against investing. So
yeah, he's not against the stock market. He just likes the public markets where things are more transparent.
I'm a modern portfolio theory guy, so I believe in high diversification. I don't have all the answers, Josh. But actually, Eugene Fama, by the way, I quoted him as he says, in a modern portfolio theory, it's only a theory, it's not a guarantee. But so really, I think really what you want to do is you want to have retirement income. You want to have people, you want to have all their bases covered first and foremost. And by the way, Fidelity Investments came up with this whole thing in 2003. Was called a 4-box strategy. So I'm not talking anything out of the ordinary.
So what is the 4-box strategy?
Well, essentially, you create 4 boxes. In other words, like, what do you need for housing? What do you need for food? What do you want for travel? You cover all your basics.
And you cover your basics with guaranteed income.
Yeah.
And you help CEOs, executives. You've helped millionaires all over the world. Do you ever get any pushback that you're a little too conservative?
Of course. So people say you're too conservative. But something, Josh, I can look at people and say, have I lost you any money?
And we can sleep at night. And I want to say, I met Barry 2006. He was like the Chicken Little. And if there's a Mount Rushmore of people who've influenced my career, Barry would be on that. So I was a little nudge. I don't know what I was at, 22, 23. And I don't know how I made this group, but it was like all these elite financial advisors and me. I remember we had great lobster. It was Lazy Man's Lobster with, it might have been Connecticut, but it was a good lobster. It was really good seafood. And you were speaking, and it forever changed my career because I saw all of the excesses you were talking about, much like now in 2006. And then I began to become a little Chicken Little. And 2008 was very instrumental in our company growing because all of the prophecies that you had shared were starting to come true. All the prophecies that I kind of shared via you. And want to thank you for being a great influence on me for conservatism. And want to thank you for being a great guest. as always.
Well, thank you, Josh. We'll have to keep in touch, yeah, because the research. I'm just, I'm at the, I'm in the last quarter of my career, or whatever, and so I know a lot of this stuff, and I think, this is, I love this country, and I'm a Christian, as you know, that's the most important thing in my life. I'll say that to anybody. I've said it on national radio, so nothing new there. But I think really, good stewardship is really, really needed, and I'm so proud of you for doing. Did you wear glasses at the time or something like that? I didn't wear.
I think I had glasses then. Yeah.
Yeah, so, but I am, and I'm so proud of you. I mean, you just nailed it, and you've done incredibly well, and I'm very, very proud of you. I mean, and yeah, and that one of the blessings of of my life. I mean, I've seen a lot of guys like you and people in Indiana and Texas and all around the country who run with some of my research and made a lot more money than I.
And some people ripped you off, and they don't give you credit, but
Yeah, but the whole thing, that's true. I'll tell you, when Tony Robbins did approach me about this whole thing, but I said, Tony, I don't think we should do business with Security Benefit. And he said, why? I said, because they're involved with private equity. And so that's another story, but it's all true.
yeah, and then he wanted you to write a chapter for his book, Money Master the Game. I also have a story about that book. So I go, there's all these inaccuracies. Because I was friends with his PR firm, Jennifer Connolly. And it was when I started going TV more and we had connections. And it's funny, they rewrote a lot of the annuity and insurance piece. And Tony kind of goes to the highest bidder. So then he went to Peter Mallouk. So the first book, he got money from Advisors Excel, which is an insurance field marketing organization. They kind of wrote that chapter. Then he got money from the other guy. What's his name? Oh, Peter Mallouk. And then they split up. But it actually was not a bad book. There were certain good chapters, and he's a great guest and he's very inspirational. But it was sloppy. And I said, this is wrong here. They were saying some inaccuracies.
Yeah.
And I had said to Jay Connolly, there are gross inaccuracies in this. Like, it's not. And then they edited those. But then Peter Mallouk, who's more market-based, head of creative planning, and Roberts was a big part in their growth. Robbins, I mean, hey, but God bless him,
I used to listen to all his tapes and stuff like that, but now I have a different, so the whole thing is that, but then he's actually come up with a book called I don't know if you've seen the book, The Holy Grail of Investing, it's all about private equity.
Yeah, it's funny. The Holy Grail one's real divergence. The Money Master of the Game, it wasn't horrible. And then it was rewritten, but it was then sanitized by Mallouk. And then, Mallouk, actually, we've had him on. He was a good guest. A little more transparent. But, well, thank you so much for joining us. And folks, what do you want to plug? Where can folks find out about your work?
Yeah, we're going to just go to barrymajamesdyke.com and buy a couple books. They'll learn planning their retirement. It's going to help them immensely. And then also they can sign up for the mail list.
Have a good one.
Take care.
Thanks.